Okay, well, thank you everyone again for your patience. I do expect that we'll have a few additional participants, but I don't want to penalize anyone who is on time. Thank you again for joining us today for this virtual press conference to discuss U.S.-China trade. I know it's a busy day in U.S.-China trade, so thank you especially for joining us here to discuss this important topic. My name is Craig Allen, and I am the president of the U.S.-China Business Council, a trade association with some 240 members. And again, we are so grateful to you for joining us today. Today is an important anniversary. Exactly a year ago today, USTR and the Chinese government announced that they had reached a so-called Phase 1 trade agreement. That agreement was signed in a ceremony in the White House by President Trump and China's Vice Premier Liu He 1 month later on February 15th of 2020. So it's probably too early to cast any judgments on this agreement, but I would note that it is still very much extant, still very much being implemented by both governments. And the Chinese government has repeatedly stated, even recently, its commitment to carrying out all of its obligations under the agreement. The incoming Biden administration has not yet expressed its views on the Phase 1 agreement in a formal manner. Notwithstanding the complex bilateral political dynamics at play in the US-China relationship, it's useful to revisit the economic fundamentals. I think it's obvious that the US-China trade and economic relationship is important, but it's less obvious what exactly our trade policy should be. There are always trade-offs in any policy decision, and it's useful always to study the costs of the decisions that you are making. So to inform this debate, USCBC has commissioned a study to look at the question specifically from the point of view of US employment. What have been the effects of the trade war on US jobs? What would be the effect on US jobs of a loosening or conversely a tightening of our trade policy? So thanks for joining us for the release of our new report on the US-China trade relationship prepared by Oxford Economics. I'm joined here today by Alex Mackall, lead economist for Oxford Economics and the main author of the report. I would note that this is an update to the last report that we commissioned also from Oxford Economics in 2017, but much has changed since that time. In summary, I will say that the tensions have increased across all dimensions of the bilateral relationship, and our trade and investment ties are no exception. Tariffs and counter tariffs on hundreds of billions of dollars in trade have been imposed, resulting in an estimated peak loss of 245,000 jobs. Most of these tariffs remain in place despite the two sides reaching the Phase 1 agreement. At the same time, the lines between commercial and national security domains have become increasingly blurred, creating yet more challenges for business. With President-elect Biden's swearing in next Wednesday, it is important to reflect on the benefits that US-China trade brings to Americans. US exports to China support 1.2 million jobs, and Chinese companies invested in America support nearly 200,000 more. The profits from US companies' operations in China allow them to reinvest in R&D and innovation, allowing America to stay at the forefront of economic competitiveness through innovation. The beginning of a new administration is also an important inflection point to examine alternative approaches to China commercial policy. Our report finds that compared to status quo projections, a drawdown in tariffs would create 145,000 new American jobs over 5 years and stimulate the US economy. However, escalating tensions and decoupling with yet more tariffs would further damage the economy, resulting in a peak impact of 732,000 fewer jobs. We believe that it is clear that the best way forward is to build on the Phase 1 agreement and negotiate follow-on agreements that remove China's market access barriers and simultaneously roll back tariffs. This will bring ample benefits to American companies, farmers, workers, and ranchers. Before I turn it over to Alex to discuss his findings, let me thank Jack Kamensky, our Senior Director for Business Advisory Services, for all of his good work on this report and his collaboration with Oxford Economics to bring this to fruition. Alex, may I turn it over to you to please present the details of our findings? Thank you.
Thank you very much, Craig. Let me just share my screen. So can you see the presentation on my screen?
Yes, go ahead, Alex.
Excellent. Well, thank you very much. And thank you to the US-China Business Council for commissioning this report on the US-China economic relationship. The subtitle of our report is A Crucial Partnership at a Critical Juncture. And I think that that's a really important point to emphasize, is that this is the world's two largest economies, and they really are at an inflection point in terms of economic and commercial relations. So our report comes at a very interesting time in examining these questions. Just a quick overview of what I'm going to discuss today, and this also summarizes the core content of the report that we've developed. Just start by looking at trade and investment ties between the US and China and how this supports US economy in terms of growth and employment. Then move on to some of the rising tensions that have taken place in recent years and the economic costs associated with those tensions. And then move on to alternative paths for the future of US-China economic relations before we draw some key conclusions. So beginning with trade and investment ties between the US and China and how that benefits the US economy, first and foremost, there are exports to China. So in 2019, the US exported $106 billion worth of goods and $57 billion worth of services. And these exports are diverse and support the travel and tourism sector, machinery and transport equipment, and various manufacturing sectors across the economy. So we estimate that these exports supported 1.2 million jobs across the US economy in 2019. Imports from China also benefit US households as a result of lowering prices. And estimates suggest that the US CPI index was 2% lower over 2000 to 2007 as a result of Chinese imports. Just moving on to investment. So US firms invest directly into China quite heavily. And in 2019, the United States invested $105 billion directly into the Chinese economy. And US multinational corporations in China have reinvested $26.2 billion in research and development over 2008 to 2019. It's important to emphasize that this direct investment by US firms into China also has benefits for the United States domestic economy as a result of increased domestic investment and increased domestic productivity. China has also begun to invest directly into the United States. And in 2019, the total stock of Chinese direct investment into the US was $59 billion. And Chinese multinational firms employed 229,000 people in the US in 2017 and 197,000 people in the US in 2018. So whilst it's important to examine these tangible benefits to trade and investment flows, the key long-term benefit to economic ties with China comes from gains to total factor productivity. And that's the efficiency with which inputs such as capital and labor are used to produce outputs such as goods and services in the economy. So the gains from trade and FDI with China result from comparative advantage in the production of certain goods and services, increased competition, and also supply chain efficiency, which reduces the production costs of US firms. And all of this contributes to the United States total factor productivity and ultimately long-term economic growth. So moving on now to the rising tensions that have taken place in recent years. So this chart shows a timeline of US tariff actions on imports from China from around end 2017 to early 2020. And as you can see from this chart, the effective tariff rate on imports from China was actually quite low preceding the trade war, so it was around 3%. And over the course of 2018 and 2019, following a number of tariff actions implemented by the US administration, the effective tariff on imports from China rose to around 21% by end 2019. Now, the Phase 1 agreement did implement a modest rollback in some tariffs, but it still left the effective tariff rate on imports from China at 19%. And it's important to note that China also applied a same equivalent tariff onto US goods entering the Chinese economy. So what were the trade war and these tariffs' impacts on jobs and economic growth in the United States? Well, tariffs were damaging to the US economy via a number of channels. First and foremost, it led to higher consumer prices. So as a result of these tariffs, there was an increase in prices to US consumers. And despite claims from the Trump administration that most of the cost of these tariffs would fall onto Chinese exporting firms, there's very little evidence to support that. In fact, most of it has fallen onto the US consumer. As a result of increased trade policy uncertainty, there have been delayed and cancelled investments. There's also a household wealth effect as a result of the financial market responses following tariff announcements. And crucially, there are also significant supply chain disruptions. So supply chain linkages between the United States and China were disrupted by tariffs as intermediate goods cross borders multiple times, and implementing tariffs on these goods raises input costs to the US economy. So as a result of these channels, Oxford Economics estimates that the cost of the trade war with China was around $108 billion over 2018-2019. That's around 0.5% of US GDP. As a result of this weaker economic activity, we estimate that there were 245,000 fewer jobs at the peak of the trade war. So absent these tariffs, if these tariffs haven't been implemented, 245,000 additional jobs would have been created in the US economy at the peak of the trade war. So in the report, we also explore several key sectors that were highly exposed to the trade war. We look at energy and agriculture, and also crucially, the manufacturing sector. So this chart shows the estimated impact of the September 2019 tariffs on US manufacturing sectors in terms of the gross value added. And as you can see, the motor vehicle sector was the most highly exposed sector in the US economy as a result of these tariff actions, which reflects retaliatory tariffs as well as supply chain linkages. But it's important to note that all US manufacturing sectors were negatively impacted by these tariffs. And that's because of the supply chain integration that exists not just with China, but also within the US economy. So as one manufacturing sector suffers as a result of tariffs, it does spill over to other sectors within the US economy as well. The trade war failed to achieve major stated policy goals from the Trump administration. So first and foremost, it hurt the US economy and reduced US employment. It hurt the manufacturing sector, as well as other key sectors of the economy, such as agriculture and energy. The US trade deficit with China did narrow in 2019, but this was offset by an increased trade deficit with the rest of the world. Tariffs merely diverted trade flows to and from other countries. There's actually no evidence that unfair trading practices by China are the cause of the US trade deficit. The US trade deficit reflects a set of broader macroeconomic trends, such as loose fiscal policy and the role of the dollar in international markets. So just moving on now to some alternative paths for the future of US-China relations. So it's fair to say that the US-China relationship is at a key inflection point. The American public and policymakers remain skeptical of China. As you can see our chart there, perceptions on China have risen to unfavorable views on China have risen to quite a high level throughout the United States. And whilst incoming President Biden will probably take a more pragmatic and measured approach to trade relations with China, he has also said he will not immediately remove tariffs. So risks do remain, and the Biden administration, whilst unlikely to raise tariffs further, may leave them in place indefinitely. Further decoupling through non-tariff measures are also a rising threat. So in light of this, we've modeled two alternative scenarios, and I just want to highlight that we compare these scenarios to a baseline that assumes a continuation of status quo trade policy. So everything that we quote in terms of the impact is essentially, it's the impact versus just leaving tariffs at their current level around 19%. So our trade war de-escalation scenario assumes that the Biden administration moves trade with China higher up the policy agenda, and following successful negotiations, tariffs are rolled back gradually to around 12% over the next 4 years. Our trade war escalation scenario assumes that tariffs increase to 45% on all goods imports from China, with full retaliation from China. The 45% tariff is the highest known threat made by President Trump. We also in this scenario assume long-term economic decoupling between the two economies as a result of supply chain and technological decoupling. So just beginning with our trade war de-escalation scenario. So this chart shows the GDP impact under trade war de-escalation. So essentially it shows how much additional GDP the United States produces in each year as a result of scaling back the tariffs. And as you can see, there's a persistent increase in US GDP, and on a cumulative basis, the United States economy produces an additional $160 billion worth of GDP over the next 5 years. So as a result of stronger GDP growth, there's also stronger employment growth, and by 2025, 145,000 additional people are employed in the US economy. Now, it's important to note that we've designed a scenario here that's perhaps higher probability in terms of likelihood, but if all tariffs were scaled back to pre-trade war levels, the transmission channels would be the same, and the impacts would likely be larger than this as well. So just moving on to our trade war escalation scenario. So this is GDP in terms of now as a time series under the trade war escalation scenario and the baseline. So the blue line is our baseline scenario, which again just assumes tariffs remain unchanged at 19% in both directions. The trade war escalation scenario, as you can see, leads to a permanent decline in the level of US GDP. So as a result of the productivity shock to the US economy from decoupling, there is a persistent shock to the US economy. It never actually returns to baseline levels. So just breaking down the decline in US GDP, you can see that exports fall as a result of this escalation in the trade war with China. And that's actually total exports, not just bilateral exports to China. And also there's a significant negative reaction to business investment as a result of rising input costs and the shock to domestic confidence. Consumption, which is the largest component of US GDP, also declines throughout the scenario, and this reflects the shock to household incomes and wealth. And again, as a result of weaker GDP growth in this scenario, we see a reduction in employment over the next 5 years. So at the peak of this scenario in 2022, there are 732,000 people fewer employed in the United States. By 2025, this impact has come down slightly, but is still negative. So there are still 320,000 fewer people employed in the United States. And that reflects the economic shock of technological and supply chain decoupling. So even without the tariffs assumed in this scenario, the long-term implications of productivity, of weaker productivity growth would be the same on US GDP and employment. So just to draw a few key conclusions from our analysis, first and foremost, the US enjoys many benefits from its trade and economic ties to China, whether that be through trade and investment. Ultimately, these benefit economic productivity in the US economy. Tariffs and other restrictive measures imposed by the US administration do come with an economic cost to the US economy in terms of GDP, household incomes, and employment. The Phase 1 agreement made some progress in addressing areas of concern around trade with China, but it also left many issues unresolved and most tariffs in place. The US-China commercial relationship is at a crucial inflection point. Scaling back tariffs would stimulate US economic activity, employment, and incomes, but raising trade tensions further will harm the US economy and result in lower employment. Thank you very much, and now welcome any questions.
Well, thank you, Alex. That was a brisk walk through many months of work, and I think it puts into very clear picture that tariffs and escalating the trade tensions not only has an impact on GDP, but it has an impact on jobs, and indeed, as many as nearly 250,000 jobs may have been lost as a result of the trade tensions. So with that, let us open it up for questions. We would welcome you unmuting and asking your questions in front of the whole group. I should note that this report, if you don't have it yet, is available on our website. And finally, let me again thank Alex Mackel and his colleagues at Oxford Economics for their terrific work at helping us to understand the costs of trade policy prior to this, and also give us a look at the options going forward. The floor is open. Thank you.
Hey, Craig.
Please.
This is Frank from China Daily.
Yes, hi, Frank.
Thank you for having this press conference. I have two questions. One is for you and another is for Alex, if I may. Yeah,
please.
First, Starbucks is one of your members, right? And the chairman, the former chairman of Starbucks, I got a letter from Chinese President Xi Jinping, and basically the president was encouraging Starbucks, the U.S. company, to play an active role in promoting U.S.-China trade cooperation and bilateral relations. So, what's your take on that? And then the question for Alex is this: with this joint report, what specific message do you expect to deliver to the Biden administration? Thank you.
Okay, well, let me take the first question. I'd rather not speak on behalf of any member. They're perfectly capable of speaking for themselves. I think Starbucks does a fantastic job at selling coffee and other lifestyle goods. But I'd really rather not analyze either Xi Jinping's letter or a potential response. I do think that trade and investment are both just naturally good things, and the more trade and the more investment that we have, the richer we all are. It has that's been the American experience for the last 250 years, and I expect it will be our experience henceforth. And thus, we encourage more trade and investment between the two sides. Alex, I would welcome you to your comments on the second one. I'm also happy to comment on that as well.
Yeah, so I think one of the key messages that we wanted to get across to the incoming Biden administration and policymakers is to just keep in mind that trade and investment is not a zero-sum game, that both the US and Chinese economies can gain from these bilateral trade and investment flows, and both economies are ultimately better off by engaging in a more cordial relationship. I think it's also just important to highlight the risks there are to economic decoupling and how much that could cost the US economy.
I think that is a very good overview. As a former diplomat, what I would add is that for any policy choice that you make, there's a cost. And indeed, for any choice in life, there is a cost or a risk. And it's very useful to know what the cost is of your particular choices. And I think that in the case of the tariffs, it's very important that we understand the full economic cost of these choices. And I think that Alex and his team have done a good job at articulating the price paid for the policy choices that have been made. And perhaps more importantly, it provides a foundation upon which we could evaluate future policy choices. And I think that to the extent that employment is a good gauge of the success or the failure of a particular policy, that this data is very useful. So we wish to make informed policy choices, and the better data we have, the better choices we will make. And thus, I think that Alex's work has been very helpful for us to frame our future policy choices as well. Thank you. Other questions?
Hi, can you hear me?
Please. Can you identify yourself, please?
Yes, this is Hannah Monacan with Inside U.S. Trade. I just wanted to, given the rising tensions in the U.S.-China relationship, do you feel like China is trying to isolate the U.S. from its allies? And what would be the implications of that economically?
Okay, I could take a shot at that. I think that China has had a very active and aggressive trade policy over the last few years. And that policy has produced significant changes in the overall Chinese trade policy outlook. Firstly, the RCEP agreement is an important agreement, especially over time, and will contribute significantly to regional integration in Asia. And that will probably benefit all of the RCEP members, but as China is the largest by far trading country in RCEP, it will probably benefit China more. In addition to that, the recently initialed EU-China investment agreement is very important, again, over time. I think that it contributes to China's reform agenda, and if put into effect, if approved by both governments, is a significant advance for China's trade diplomacy. I would also note that while the Belt and Road policies are not specifically trade policies, they have significant trade policy impact and investment policy impact. And putting these three innovations together, China is moving towards a more rapid regional economic integration in a quite forceful manner. Now, both Premier Li Keqiang and President Xi Jinping have both said that China is interested in joining the comprehensive and progressive Trans-Pacific Partnership. And I think that we need to take them at their word for that. And that again, if China did that, it would significantly advance China's internal domestic reform agenda. And thus, I think that it is not unlikely that China will pursue membership within the comprehensive and progressive Trans-Pacific Partnership. The Chinese economy is doing very well now, and its trade policy is certainly a part of that, but certainly not the only part. But expanding trade liberalization, particularly on a regional basis, has been very effective for China over the last 40 years. And it looks like that is a policy that is set to continue. Thank you. Other questions?
Hi.
Welcome your questions on any subject.
Hi, can you hear me? Can I ask a question?
Yes, please, Lei Chen.
Hi, this is Le Jun with People's Daily. Thank you for having this. I have a question for Mr. Allen. U.S. government has taken measures to delist 3 Chinese telecom companies from New York Stock Exchange. And furthermore, it also require other listed Chinese companies to meet with the U.S. accounting transparency requirements. So what's your comments on those U.S. government measures? And do you see any possibilities that of rollback of those measures in the new administration? Thank you.
Well, I think that just as American companies in China are required to follow Chinese laws, Chinese companies in America should be required to follow American laws. And transparency on our stock exchanges is a very important principle that all American, indeed all companies, follow. Now, there have been some issues about full transparency and accountability and accounting standards of Chinese companies listed on our stock exchanges. So I think that if Chinese companies are willing to meet those high standards, they should be welcome on US stock exchanges, and if not, it might not be appropriate for them. I would note that there have been many listings this year, and that there's a long line of additional Chinese companies that wish to list on American stock exchanges. Generally, I think that that's a good thing. Chinese companies have delivered returns on average that are quite good. And many American investors wish to be a part of the China growth story, and this is a way for them to do so. But that accounting standards and transparency of accounting is very important, and I would be remiss if I didn't note that there have been problems in the recent past. For example, with Luckin Coffee that have raised questions. So this is a dynamic area and an area that will continue to hopefully grow and change in accordance with American regulatory standards. So we look forward to additional companies listing on the Chinese companies listing on American exchanges insofar as they are able to meet American listing requirements and maintain those American listing requirements. Thank you. Other questions?
Hi, Craig. It's Dave Lauder at Reuters. Can you hear me?
Yes, thanks, Dave. Go ahead.
Hey, how are you? Okay. So your colleague over at the Chamber, Myron Brilliant, yesterday had talked about the possibility of a high-level delegation of Chinese officials coming here early on in the Biden administration to try to, I guess, get things started off on a good foot. What do you know about that? Is that your anticipation as well that we'll see a group coming over? And also, what are you concerned about in the final days here? We're less than a week out here in this administration, but are you concerned that there will be even more actions that would sort of make tensions rise? More punitive actions against Chinese companies, for example. Thanks.
Great, thank you, Dave. I appreciate the question. We also have heard rumors that there may be a high-level Chinese delegation coming to Washington. I think that that's more in the rumor stage right now, rather than a hard planning stage. There are two reasons why I would be somewhat skeptical of these rumors. The first is that there is an epidemic raging about us, and that makes travel very inconvenient, and the Department of Homeland Security has just put in measures that probably Chinese leadership would meet, but that may not be convenient. The second reason is that, as at least of today, the Biden administration does not have any confirmed cabinet members. And for those who are nominated but not yet confirmed, it is not advisable for them to meet with foreign leaders. And that's an important principle. The Senate committees, the confirmation committees, are very serious about you're not doing the job until you are confirmed. You don't have the rights until you are confirmed, and that is their oversight responsibility. And so until there are confirmations of a good number of cabinet and preferably sub-cabinet level members, I think that it might be premature. A third reason is that the Biden administration has said for a long time that it wishes to work with friends, allies, and partners. And I think that there hasn't been time for that discussion to take place yet. And I know, or I suspect anyway, that senior members of the incoming administration are anxious to do that coordination. And then finally, all this work could be done over the telephone, over video platforms. And it's just a lot easier and equally effective, maybe not equally, but almost as effective to do it virtually as it is in person. While nothing can replace the in-person contact, and we certainly want to get back to that, it may be premature for visits going either way. Thank you.
Okay, and what about on final
Oh, yeah.
final actions
So
here in
just
the waning days?
Yeah, thank you. So just an hour ago, the Commerce Department issued an interim rule to secure the ICTS supply chain. I recommend that you all take a look at the Department of Commerce website because while this has been in the works since 2019, I believe, November 2019, it has finally emerged. And I think that while this is only out 1 hour ago, and thus I'm reluctant to comment on it, I think that it's quite an important piece of rulemaking that we should all take a close look at. I'd be happy to discuss it in the future once we've had a chance actually to read the rules. But I think that no one should doubt that it is important. Dave, I hope that that's useful. I welcome any other questions from anyone.
Can I ask a question?
Of course.
Hi.
Mao Ling, please.
Hi, this is Mao Ling Sheng with Xinhua News Agency. Great to see you there. I have two questions. First one is about incoming President Biden's economic cabinet. So he has laid out, he has finished his nomination recently. So there is Treasury Secretary, USTR, and Commerce Secretary, or these names are already out there. So I was wondering whether you could talk about from those nominations of the economic cabinet, what are the implications for U.S. trade and economic policy toward China? What does that say about his policy agenda? Secondly, I think there is high expectation for Biden to focus on economic recovery domestically, especially because of right now the country is still seeing surging COVID-19 spikes. There is some thoughts about whether U.S.-China trade relationships would not be like the most immediate priority here. I was just wondering whether you could share some thoughts on that as well.
Yeah, thank you, Mao Ling. So let me say about the incoming economic team that they are all very pragmatic, principled, and practiced. That all of them have been, if not in the same position, that in similar positions in the past. So they all have the experience that they need to relatively quickly take up the reins and begin governance. And I'm very happy about that. They're not going to spend a lot of time finding their way about the office. They know the office. They have worked on these issues in the past. They have consulted with the outgoing administration, and they will be ready to go next week to the extent that they're confirmed. So this group of economic policy decision makers is pragmatic, principled, and practiced, very experienced, and so I expect a steady hand on the steering wheel for sure. I think that you are correct in the assumption that they will be focused primarily at first on U.S. domestic policy. And of course, that's the right thing to do, given that we have quite unusual economic circumstances now and a great deal of stress among many industries and professions, and particularly on a regional basis. And the economic policy that we have had has not fully addressed much of this stress. And I think that there is a realization also, very correct, that economic policy can't really be put right until COVID, the epidemiological crisis, is firmly dealt with. And so the priorities must be to deal with COVID-19 and our epidemiological crisis, to address in an urgent manner the economic consequences of COVID, and orient ourselves towards longer term growth. Of course, the United States is not the only country in this position, but with the new incoming administration, it allows them to start off fresh with a new Congress, including a Democratically controlled Senate, to make the appropriate changes in economic and other policies. So it just makes sense that there's going to be an intense focus on some intense problems. And I think that we all wish them well in this difficult task. So Mao Ling, I hope that that is responsive to your question.
Yes, thanks.
Other questions?
Can I also ask a question to Alex?
Of course.
So Alex, you mentioned in the PowerPoint that there is a scenario for trade war de-escalation, where tariffs rolled back gradually to about 12% over the next 4 years. I was wondering whether there is a specific expectation why the group has specified this figure. Is there any likelihood, or just what's the thoughts behind the number? Thanks.
Yeah, so there's a lot of evidence that once tariffs are in place, it's harder to remove them than it is to implement them, essentially. Now we've seen already from President Biden, he's criticized, or incoming President Biden, that he's criticized the Trump administration's use of tariffs, but also said that he's not going to remove them immediately, which I think speaks to that point. So when we designed this scenario, we designed a scenario that was plausible in that it will, even on an optimistic basis, it will take time for tariffs to be rolled back in this gradual way that we've done in this scenario. Now, that's not to say that, you know, they couldn't be rolled back faster or at a slower pace, but we came up with some plausible assumptions as to the timing of tariff rollbacks.
I think that the U.S.-China Business Council's position would be that we should have some further consultation on the phase 2 issues, and then a reciprocal rollback of the tariffs as expeditiously as possible. And we're hopeful that the two governments will meet in the near term to agree on that. And I think that that's not implausible, nor is it politically impossible for either government, and it would bring profound economic consequences to both countries and improved economic circumstances for the world if we were able to do so. Particularly as China pursues, if it is pursuing a domestic liberalization agenda, now is a good time in the midst of global economic crisis to pursue that very aggressively.
Greg, this is Jessica Stone. I was hoping I could ask a question. It's nice.
Of course, Jessica.
I wondered if you're getting a lot of feedback from companies operating in China about this. I believe it's been translated as the sort of no ban law in China, and to what extent you're concerned about that affecting profits and and sort of long-term viability of American companies in China?
Yeah, thank you. The Chinese government has put into place a number of new laws recently that we're looking at with a great deal of interest. And the law that you're referring to is certainly one of them. The intent of the law, as I understand it, is to prevent the extraterritorial application of law in China. The details are very important, and we're interested in obtaining further information from the Chinese government on how they plan to implement these laws. I think that not only US and China, but around the world, we all need to be wary of conflict of law situations where companies from one country are put at jeopardy in that they're unable to meet both sets of laws. Governments should generally watch out for that and should not put companies in that position. And if so, it is highly probable that the unintended consequences will be large. Companies will have to comply with the law wherever they are. And if that is made impossible, then economic interaction, trade and investment becomes much more difficult. So we will be watching this very carefully. I can report that there has been a significant amount of discussion on this, but we really need more detail on it if we are, before we can make any substantive comments. Thank you. Other questions?
I could just ask one more, Craig, and that's about Catherine Tai, the USTR designate. Have you had a chance to meet with her after her nomination? I think you actually, at least as an organization, have worked with her in her capacity on the House side previously.
Sure. We know Catherine very well. I sent her a note after her appointment. And actually, we had been scheduled to meet, but that other things, she was appointed, and so that didn't work out. She has her hands full right now, and we respect her need to prepare for her confirmation, and thus we have not had any substantial contact with her since her appointment. We wish her well and a speedy confirmation because her expertise is very much needed, and our trade policy henceforth is a very important part of our overall economic policy, and there's nobody finer to lead that than Catherine Tai. Thank you. We'll welcome any other questions. Going once, going twice. Okay, well, let me thank everyone for participating in this program. Let me thank Alex Mackel and the wonderful team at Oxford Economics. Let me thank Jack Kamensky, who worked so hard on this report on our side. The report is available on our website. I am available to you through through Doug Barry or our fine communications team at your convenience. Thank you all and have a great day. I think that we can adjourn. Thank you very much.